Hello and namaskar viewers, I am Sanjeev Pandya welcoming you to the Tax Talk right here on ITV Gold. This is the weekly show based on the taxes, of course, all the guidance, all the information and the suggestion on how to do your taxes and how to save money on your taxes and what are the benefits that you can take when it comes to your taxes. That's all being done by Mr. AJ Kumar of Science CPA Services, a full-fledged accounting firm in the business right here in New Jersey with 2 locations, and they're providing all full-fledged accounting services, whether it's a small business, personal tax returns, corporate tax returns, and everything else. And of course, the tax season is over, but tax season may be over, but when it comes to businesses always stay in the business, and the taxes related to the business, that's all we need to talk about. So first, I'd like to welcome Mr. AJ Kumar. Sir, welcome, and good to see you after a long time.
Absolutely, thank you. No, the tax season was tough, and I'm glad it's over. I'm glad a lot of people are happy that the tax season is over. But as you rightly said, a small business never sleeps.
Yes.
They are open, and so are we. We'll be bringing a lot of information for your small business as what can you deduct, how do you plan, what can you do now after the season is over.
Absolutely. You know, they say it's not over till it's over.
It's never over.
So it's never over. You may take a little break, but then all the extensions that you have filed, you'll be filing the tax returns come October.
Absolutely.
And in between that, there will be a lot of planning and discussion and what not to do. And before you know it, December will be here anyway.
Yes.
All right. So businesses, let's talk about small businesses. Small businesses, they actually work very hard. They thrive to stay in the business. And when they stay in the business, obviously, they also incur a lot of expenses. Now, what expenses can be deducted, and how small business can take advantage of the deductions that are available to you. So we're going to discuss that in this episode. But first of all, let's start with small businesses. How do you define a small business?
Well, it depends on the industry to industry. Any business is small business unless they reach to $25 million. That's the IRS definition. But in your type of business, if it's a grocery store, you don't really see privately held grocery store as large business. If it's ShopRite, it's large business. If it's your small business, any grocery store, Indian grocery store, that's a small business. So for the viewer's perspective, any business that you see, unless it's a franchisee, unless it's a big brand name store, it's a small business that you're dealing with. And in any small business, working every day is part of the small business. So even though tax season is over, but we will be bringing a lot of information as what you can do now from a planning perspective, from a strategy perspective. Please remember, a penny saved is a penny earned. A lot of small businesses are very good in doing what they know. They're good in doing their small businesses. They're not as good in keeping the accounting, keeping the books. So they leave a lot of money on the table. IRS will never send you a message, never send you a letter, hey, you paid us $10 more. If you pay them less, they'll be happy to send you a notice. You will get an IRS notice if you don't pay them, but you should have paid them. But if you pay them more than what you should have paid them, you will not get a notice. The onus, the responsibility remains on you to claim what you should have claimed.
Okay, interesting. Now, all these business owners, throughout your 20 plus years of experience, as a CPA, MBA, and a professional tax filer, have you come across business owners that they are not aware of the certain deductions as a part of their business expenses that they can take advantage of it?
You wouldn't believe how many times it happens. I see it happening every day. The common mistake, my business needed money, so I put it on my personal credit card.
Oh.
My business needed money, or I needed to pay this vendor, so I paid the money through my personal bank account. Happens all the time. And the worst part, just because it did not go through the business account, a lot of time these business owners, when they are reconciling their books, when they are giving this information to their accountant, to their CPA, they forget what they paid through the personal credit card, what they paid through the personal bank account. And they miss that expense and miss a lot of money on the deduction, on the tax saving. So the right way of doing it, if you have to fund your business, if your business does not have enough money, instead of paying the vendor, instead of paying the salary directly through your personal account, please transfer the money to the business account. Your business has to be a central location for all your business expenses. Tomorrow, God forbid, if somebody wants to audit you, you can clearly show the paper trail. Hey, the business needed money, so I transferred money from my personal account to the business account, and then I paid the money. It helps keeping all the expenses together, Sanjeev ji.
Absolutely. Now, can you tell us the basic business expenses that they are deductible?
Absolutely. So there are certain expenses that are sort of common for a lot of businesses. Say business startup expense. You have a business, you must have started the business. Utility, you must have the light, gas, whatever utilities you have. You probably have the rent. Unless you're running from your basement, you have the rent expense. Unless you are working for yourself and you are the only one, you probably have the payroll, some payroll taxes. Depending on the business type, you have some licensing. Depending on, again, on the business type, you have some cost of goods sold. If it's a consulting business, you probably have a laptop, you have phone, you have utilities. So there are some expenses that are always there that you don't have to justify. As long as you have the proof of payment, all these expenses are legitimate expenses for any small businesses.
Okay. The insurance is also one part which is deductible.
Depending on the business type, insurance can be a large expense, especially if you're in medical field. Insurance expenses are heavy. If you are in travel, if you are a trucking company, insurance expenses are huge.
And besides the payroll, professional fees such as consulting fees or any
absolutely, professional fees,
also.
Consulting fees, any out-of-pocket expense that you wouldn't have had if you did not have the business is simply a business deductible expense. If you had expense that you would have had anyway, say for example, my meal, I would have eaten anyway. My home, I would be living anyway even if I did not have the business. They are not business deductible expenses. I have one car. I had one car before I started the business. Is that a business deductible expense? Unless I'm driving the car in addition to what I used to drive. Say for example, my business is in East Brunswick. Now I drive to East Brunswick back and forth, which I did not do earlier. This additional mileage is deductible. So any additional out-of-pocket expense that you have because you have the business is a deductible business expense.
Okay. So what is not deductible? What expenses are not allowed by IRS to deduct as a business expense?
It depends on the business type, Sanjeev ji. Say for example, meal expense used to be highly scrutinized. Travel expense used to be quite scrutinized. For 2021 and for 2022, IRS has allowed 100% meal deduction. It used to be 50%. And the theory was, if you are going out with a client, you would have eaten anyway. So we are not giving you the deduction for yourself. We are only giving deduction for the client. But now for these 2 years, for 2021 and for 2022, under the COVID-19, just to fuel the economy, IRS has modified the rule and allowed 100% of the meal deduction. That's a great thing. So if you keep the receipt or get a credit card for the business, try to have all the business meal expenses going through the credit card. That will allow you to keep everything centralized.
That's for the year 2022 as well?
That's for year 2022 as well. That's why we want to highlight in our show for our small business viewers. So if they're going out, maintaining the receipt or having a business credit card is very important, so you can see all those expenses together. But for your question as what expenses are not deductible, the IRS does not allow fines and penalties to be deductible. If your business has some sort of fine or some sort of penalty, that's not deductible. If your business is doing lobbying or political contribution, that are not deductible expenses. In some cases, under a Section 179, if you have large machine purchase, large capital expenditure, you may be forced to depreciate those expenses as opposed to claiming those expenses in the year of purchase. So just be careful as what you are claiming. Again, the basic principle is this an expense that's necessary and customary in my type of business? Do people have this expense typically in this type of business? If that's what you have, then it's a deductible business expense.
Okay, so now we actually viewers, we're going to have a very important topics covered in this episode of the small business deductible expenses. But before that, what are the similar expenses that that can be deducted in almost all kind of businesses, whether it's a LLC, S corporation, C corporation?
Well, it's not about the LLC, S corp or C corp. It's more about what you are doing under this business, what type of business you have. Say, for example, all the grocery stores, irrespective if they are LLC or S Corp, will have similar expenses that they can claim. All the restaurants, irrespective of if they are LLC or S Corp, they will have similar expenses they can deduct. All consulting companies, CPA firm, will have similar expenses, irrespective of the fact if they are an LLC, proprietorship, partnership, or S Corp. In a typical consulting firm, a CPA firm, doctor's office, IT consulting company, you will have payroll as a large expense. You will have rent, utility, insurance, professional fees. Typically, those are the expenses. You don't really see cost of goods sold in a typical consulting company. On the other hand, in a restaurant, in a grocery store, you will have large cost of goods sold. You have to buy something to sell something. You don't really have large payroll expenses, comparatively speaking, depending on how big the grocery store is, how big the restaurant is. The payroll expense could still be high, but from a consulting company's comparison perspective, the payroll expense will be much lower and cost of goods sold will be much higher in a typical grocery store or a pharmacy as opposed to a consulting company, Sanjeev ji.
Okay, so just common expenses are deductible in no matter what kind of entity that you have.
Absolutely.
That's what I want to make sure.
Absolutely.
Okay, with that note, let's take a short break, viewers. But when we come back, we're going to have a very important topics covered. That what if someone has already spent some money before the business was set up for the business? Can it be deductible once the business has started? This has been a gray area, and Mr. AJ Kumar will definitely guide us more into that, and obviously additional topics as well coming your way right after these messages. Welcome back to the second half of the Tax Talk Show right here on your favorite TV channel, that's ITV Gold. I'm your host Sanjeev Pandya, and I am joined by Mr. AJ Kumar, CPA and MBA with Science CPA Services. Over 25 years they've been in the business, full-fledged accounting firm with 2 locations, and they can be reached at 908-380-6876. That's a 908-380-6876 for any tax matter, whether it's a personal or corporate tax matter as well as a business matter. You can definitely contact them, and they will guide you in the right direction, as they have been doing it for hundreds of thousands of individuals in the country, and they're willing to help you out. 908-380-6876. In today's episode, we're talking about small businesses, what expenses can be deducted, what cannot be deducted, and what are the other areas that small business owners should know about it. AJ Kumar, the question I want to ask you is that, let's say if somebody wants to start a business, but obviously to start a business, a lot of planning, a lot of research goes into that effect. And with that also money is being spent also. What I want to know from you is that pre-business planning expenses, can it be deductible?
Yes and no. Let's take a step back. Let's understand the concept first. So a lot of businesses, as you rightly said, take some time before they can get to a point when they know they can start the business. They initially don't know. Initially, a lot of these businesses, it starts as a hobby. So if you're starting a business as a hobby, then the expenses related to the hobby are not deductible. But let's say you go to an accountant, you go to a CPA, and the CPA wants to charge you some money to start the business. You pay the CPA before the business is started. The CPA wants the money up front. Then you're paying the money from your own personal account. That's a legitimate business deductible expense. Sometimes it takes 6 weeks to register the business, depending on which state, what type of ownership you have. And then you have to pay certain fees for the licensing upfront, as long as your expense is related to that business that you are doing. As long as you have the intent to register the business, once you are paying the expenses out, it was not started as a hobby. And as long as it falls the same year. Once you have filed the taxes for the last year, then you start to sort of claim it, then you cannot do that.
Then you can do that.
But if you have started the business in March, you had some expense from January, February, it's all fair to put those expenses in the business expense.
Okay, so that means it's a good to make it a point here that if you have spent money anywhere from, let's say, January 1st of any year till August, September, and then you start a business, it's all deductible, provided that you prove it that it was all business related expenses, whether you paid someone for consultancy or the research fee or this expense, that expense, legitimate expenses. But up to a certain point it can be deductible so long as it's within the year. You can't go back.
It has to be within the year. It has to be related to that business only, and at the time of having the expenses you must have an intent to make profit in this business.
There you go. That's the word I wanted to hear. Profit. All right, let's talk about profit. Not all businesses make profit.
Right.
All right. What if a business is consistently losing money over a year after year after year? When they come to you and you look at it, and as an accountant and from IRS's point of view, what kind of questions would you ask the owner?
Well, there has to be a legitimate reason for you to be in the business if you are consistently losing money. Why don't you stop it? Why don't you close the shop? If you are losing money, what's in it for you to be investing time into it? It's okay to invest 1 year. Sometimes it takes 2 years. Sometimes it takes longer. But how are you getting there? If 3 years ago you lost $100,000, 2 years ago the loss was 50, last year it was only 20, I can see a clear progression that you are reaching there. But if every year you are losing $100,000, $100,000, $100,000, the question is, why don't you stop the nonsense? It's not working out. Get something else. Do some other business. It's really not a business. A business has an intent to make money. If you are losing money, what advertising are you doing? How are you planning? How are you trying to change the situation? How do you turn it around? What's your plan? If there is no such plan, then it's not a business. It's a hobby. And in lot of cases, IRS just denies those expenses. They will disallow these expenses, saying this is not a business expense. This is just a hobby, and hobby expenses are not deductible.
Okay. If that's the situation, if business is consistently losing money, tell me, is it a truth or a myth that in the majority of the businesses when they show a loss is because the owner or the employees of the owners, if it's a family-owned business, they take out too much money as a salary and that's why they result losses?
No, that's a myth. That's not how it works. So if you are taking a large salary out of your own business, it becomes taxable income to you. Let's say your business did not make any money, zero, without your salary. You took $10 out of the business as a salary to show a loss of $10. Now when you file your own taxes, you have to show this $10, the salary that you took, as a taxable income. Even though you're offsetting the loss, it's not really helping the bottom line. So taking large salary out of your own business is not a business tax strategy. It does not save you any taxes.
Okay, good. Small businesses and a home office, these two things are very, very common. When it's a home office and you manage your business from your home, which you call that office also, what are the pros and cons of it?
Well, home office expenses are very common, especially in the last couple of years. Under COVID situation, they have become more common than they used to be. Everybody has a home office. Now, the IRS definition is that it has to be an exclusive place which is regularly used for this business. It can't be a table in the bed, in the bedroom or in the drawing room. So it has to be an exclusive place that's only used for the office, and it has to be regularly used. It's not one of those things that I do it whenever I need to, or every Saturday I work from there. It has to be regularly used for the client meetings, for the business meetings, and exclusively used for business only. In that case, you have the right to deduct that space related expenses in your business. And how do you calculate that space related expenses? Let's say you have a house of 3,000 square feet. You calculate how much is the square footage for your office. And let's say if it's 300 square feet, then technically 10% of your utility, 10% of your rent, 10% of your mortgage, all those expenses proportionately can be deducted as your business expenses.
Okay, very good to know. What about retirement planning? Can retirement planning be possible in a very, very small businesses we're talking? And earlier you said small business can be up to $25 million. That's a huge amount, but I'm talking really mom and pop type of business. retirement planning? Is it possible?
Absolutely. Retirement planning must be an integral part of your tax strategy for a small business. If you have a small business, especially the small business that is showing profit, that's making profit, you have to consider some solo 401k, some SCP, some SAP IRA. Especially if it's a qualified business, you should consider the QBI deduction. There are a lot of tax strategy, tax planning that you can do for your small business. Not only it will reduce your taxable income and saving money your tax liability, it will create a nest for your retirement situation. When you retire, you will have some money in there. And a lot of small businesses where you have no employees, it's very easy. The list you should consider is SEP, SAP contribution, Simplified Employer Pension Plan contribution. That's very easy, relatively no cost. You should also consider 401k. Please remember, if you have employees, whatever plan you offer to the owners, to the shareholders, to the members, similar plan must be offered to all the employees. You cannot be biased about certain group, certain owners. So whatever plan you decide, you must give it to everybody.
It should be same for everybody. All right, one of the last few questions. This one is for a business owner, of course, would file his or her personal tax return as well. If they take standard deduction on their personal tax return, can they also take business expense also?
Well, each expense, Sanjeevji, can only be taken once. You cannot be duplicating the expense. You cannot be double counting anything. But business expense typically go through a separate business tax return. If it's an LLC, typically you will have 1065 filer. If it's an S Corp, you will have 1120S filer. Or if it's a Schedule C business, like a single member LLC, you own the LLC 100%, you have a separate schedule, Schedule C in this example, for your all business expenses. The standard deduction is all about itemized versus standard, which is Schedule A. So medical expenses that are limited to 7.5%, in excess to 7.5% is deductible. Then you have some charitable contribution. Then you have some mortgage interest and property tax. Property tax is limited to $10,000 under SALT deduction. So those deductions are compared with the standard deduction. Business expenses have nothing to do with the standard deduction.
All right, so that's good to know. Last question now, as we have 1 minute to go to. It's about audit and small businesses. Can small businesses be audited, and how far IRS would go to audit their books?
Well, IRS is a big, giant business organization. If you are not making money, typically they won't bother you. Higher the income, higher the probability of being audited. Please remember, 90% of these audits are computer generated. Unless you make something silly on your a mistake on your tax return. Say I had a client and this lady was making $20,000 on single member LLC. All her expenses, the uniform, the utility, the travel, all were in $1,000. 2,000 utility, 1,000 travel, 2,000 uniform, 1,000 meals and entertainment. All the expenses were in $1,000. I mean, you wonder out loud. I'm not saying they are not right, but how do you have everything in $1,000? It simply means you are just estimating the expenses, unless you make a silly mistake. IRS does not really go out of their way to audit the small business. Another example, I had a restaurant client. This client was showing $400,000 of losses on a single restaurant. I mean, how can you afford to be losing $400,000 year after year? Why don't you stop the nonsense? $400,000 has a lot of zeros in there. It's a lot of money. So if you lost $400,000 once, learn from it. Move on, find a job. But when the IRS sees $400,000 of loss last year, $400,000 of loss this year, they will have to audit you.
But see, you don't know what goes behind the doors in that small businesses, and
absolutely,
if the owner has the guts to show $400,000 loss year after year, there is something fishy out there.
Yeah, it's suspicious.
Yes.
And they just want to see what happened.
Correct.
What's your story?
All right.
And as long as you have a story around it, you're okay.
Exactly. And that's a story for today. You know what happens in the tax talk show, and that's what we discussed today: small businesses and what can be deductible, what cannot be deductible. And also Mr. AJ Kumar gave out a lot of other information related to small businesses. Hope you found it very interesting. Next week when we meet again, we're going to have another important topic for you to discuss in the tax talk show. Mr. AJ Kumar, thank you so very much.
You're very welcome.
And
Thank
looking
you.
forward to see you for the next episode.
My pleasure. Thank
All
you.
right. I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. So long.